Thanks, Paul, and thanks for that introduction. And thank you for ShareCAF for the opportunity to tell our story. It's going to be a brief presentation just to introduce you to this Janus Henderson product. As Paul says, it's called Net Zero Transition Fund. It's an active ETF. It's listed on the ASX, JZRO. And all the companies that we own, you can see in our basket there. It's all public information. We've basically got a basket of 50 companies. And those companies, it's global. That's very important. 50 global, broadly speaking, resource companies. You might be surprised about how broad the portfolio is, and that's very deliberate. We want to diversify away from what can often be a highly volatile sector. Next slide, please. So, sorry, the next one after that. I'm okay on the, yes. So this is just an example, simple slide. When we talk about net zero, continents, countries everywhere, trying to get to net zero by 2050. What that basically means is taking enough carbon out of the atmosphere to ensure that we don't warm any more than 1.5 degrees centigrade by 2050. That's a long way away. But in reality, let's use Europe as an example. There they were trucking along at 4 gigatons of carbon emissions spewed into the atmosphere every year. That's 4 gigatons. That's the same as 4 billion tons. So these guys, there's regulations in place. This is the exciting thing. How do we reduce that by half? How do we reduce that to 2 billion tons by 2030? Now, for you investors out there, and the way we think, look, 2030 is not very far away. And there's a real sense of urgency about how we can help decarbonize. Now, this is Europe. It was only 18 months ago, they were the leader. But now American, because of the Inflation Reduction Act, something like 300 billion of tax credits going in right now in a very practical way to reduce the American emissions. Next slide, please. How big is this problem globally? This is a BHP slide. You can see the green line there is basically the primary energy, all the coal and oil we use. It emits almost 40 billion tons of carbon a year across the whole world. By 2050, that needs to come down to about 9. Now, that is a massive, massive target. And I think you should appreciate that steep part of the curve there. It's happening over the next 7 or 8 years. The big changes have to happen quickly. Trillions of dollars have been spent on this mega theme. The sorts of things that will end up by 2030, we'll probably have 2 or 3 billion electric vehicles on the road. We'll probably 1 in 3 homes will be heated by solar or powered by wind. You'll have this thing called CCUS, carbon capture, utilization and storage, storing carbon underground. There'll be in excess of 10,000 of those projects all around the world, and millions of acres of increased forestry. Now, they are just the practical things that need to be done for everyone to contribute to reducing carbon. And so there's this real sense of urgency. But remember, what we like, this is a mega theme. It's not just going to be here for the next 2 years. We're trying to encourage investors to get set now for something that's likely to continue for decades. Next slide. Now, this might surprise you. What is a decarbonisation? How can we benefit by helping the world decarbonize? And of course, it's good that we've got this basket of opportunities to decarbonize, but really what we're doing, this is a thematic to make our unit holders above average returns at different parts of the cycles because of this mega trend. Now, we don't want to just put you into normal resource companies. You might think of gold or silver, you might think of platinum and highly volatile prices. We're trying to minimize the volatility. We won't always be successful, but by having these 5 thematics, It's like going into Novotel in the morning and having a great buffet selection. We can choose where is the good value, where is the momentum, where are the catalysts. And within these buckets, within the energy transition, obviously you've got renewables, but then you've got the metals. You can't have a big wind turbine without massive amounts of high quality steel, or you've got to have low carbon aluminium. So we need to access those companies that can do that. We want to invest in hydrogen. And I can tell you now, if you want to invest in hydrogen in Australia, it's not going to be that fruitful over this time period. The big money's to be made out of the high-tech companies or the experienced companies in America when it comes to hydrogen. And then when you look at sustainable mobilities, think of electric vehicles. We need copper for that. We need lithium for that. Lithium demand is going to increase 10 times. No one knows where it's going to come from, really. Then you've got sustainable industry. This interests me a lot because the best way to reduce carbon, actually, if you're in steel, is to recycle the steel at 0.5 a tonne of CO2 emissions. If you made that from virgin iron ore and coking coal, it'll be 2 tonnes of emissions. Who wants to spend billions of dollars to reinvent the steel market when the smarter players at the moment can already do it with recycling? That's really important. Then you go into sustainable agriculture. Think of companies like a John Deere, highly digitized tractors, big data, only put the fertilizer in the right place at the right time and the right amount. All of that reduces carbon. Be careful on what we invest in dairy. Is the dairy company up to play with regard to carbon mitigation? And then we look at something like carbon reduction bucket or thematic. Think here of that CCUS, carbon capture, utilization and storage, pipelines all over America, special wells being permitted by the EPA so that you can inject CO2 deep underground and it stays there. So very broad buckets of opportunities, are long-term thematic, and we're trying to mitigate against too much volatility. A good example on the next slide, just using copper as an example, we're going to find lots of corporate opportunities. You've seen corporate action in lithium. You'll see lots more. In copper, you've already seen Rio Tinto take over Turquoise Hill, a great asset, but in a higher risk jurisdiction and only a single mine. You've got companies like Anglo-American copper mines all around the world could be vulnerable to take over. What this slide doesn't say, BHP sold Woodside for $15 billion. Those guys, BHP wants to put $15 billion into copper, basically. How's it going to do that? Half of that's gone into Oz Minerals. We suspect the other half will go into Latin America, new emerging copper opportunities. Next slide, please. And last but not least, it's important we be, this is an ESG certified fund. It's a lot of the companies we own, sure, 60% of them in America, it's global. A lot of them are mining companies. They're not all recycling companies. Mind you, by the way, there's no fossil fuels in here. There is uranium, but MSCI, they rate us, their sustainability measurements, metrics, we're rated AAA. We've got low carbon footprint, as you expect. Now, just to finish, it's a very short slide presentation. I just want to try and whet your appetite into how we look at decarbonisation, how you can invest in it on a long-term basis. I'm not talking 1 year, I'm talking 5 or 6 years to get above average returns at a different stage of the cycle to other parts of the market. And I hope I've kind of demonstrated to you, we've got, I haven't talked about pricing, but when lithium has to increase your supply 10 times, then copper's got to increase its supply 30 or 40%. It's not enough copper around to do that. Copper is going to get priced as a scarce commodity. That's a kick of the portfolio. Exploration discovery is a kicker. New technologies is a kicker. And we can do all that with the 5 thematics and with an ESG rated metric. So Paul, over to you.
Thanks, Tim. Great presentation. Got a lot of questions. just start with the first question. Yeah, you mentioned about M&A going on in the sector in EV. Are you surprised that oil and gas companies now are starting to look at assets in the EV chain? And do you think we'll see more of that over the coming months, years?
Yes, I am surprised, to tell you the truth. I mean, there's Exxon. They're looking at all their well data in America and saying, well, how much when we drill these holes and we've got water and going into the well, how much of that water is high in lithium? And so I am surprised, actually, but I'm not surprised on what's been happening before that, with Total or BHP or Shell, to various degrees, saying to their shareholders, maybe they go a little bit hot and cold, but basically they're kind of saying we need to be 20 or 30% alternatives by 2030, because they need to keep their stakeholders on side while they learn the ropes themselves.
Good, great. And another question here. The active in the ETF name would suggest the makeup of the fund is consistently being tweaked by yourself. Is that correct?
Yes, it's tweaked. We've got a strong team. We've got 5 people. We look after global natural resources. We look after about 800 million. So we got different skills that get called on for this portfolio. So it's not like I just run this on my own. We run it as a team. Sometimes it gets tweaked more than what you might think, because people are vulnerable to the mood of the market, but also to protecting shareholders. So it's always been tweaked, but it's been tweaked by a team rather than just me.
Gotcha. And where do the constituents of the fund mainly come from? Is it predominantly S&P, ASX listed names, or do you cast your net wider?
No, we would like to cast our net very wide. So we do a lot of market in New Zealand. The fund is a young fund. It's like a year old. And the most of the backing for the fund at the moment is through Janus Henderson, through their seed financing. And so while we build up the interest, using these sort of seminars, going to New Zealand, talking about the equivalent products over in the UK. So, we think over time, and it's been slow, we think over time retail, this is a great product for retail. But as it gets proved, we also think the institutions who are not all up to speed, institutions who want to participate in this with less volatility to a normal resource portfolio, I think we'll be targeting them as well.
Fantastic. Another one here. Do you have a preference, or is there a criteria you apply on the stage of development? For example, do you favour greenfield, brownfield, or fully developed assets?
Look, that's a good question, a whole lot. Because but each one comes with different risk. And so at the very start, we do have some companies that'll have above average exploration potential. And then while the exploration is made, then you'll get this great S curve. You'll get this great kicker up that we can take advantage of. And we've got companies in the portfolio. I can mention the names because they're public, like Philo and NGEX. And NextGen, these are all companies that are making big discoveries. So that's important. Then often what happens after the discovery, they need money, the market gets worried, it takes permitting, and then you go through a double dip. And then once it starts up again, so I would say maybe, I'm guessing, maybe 10 or 15% of the portfolio in the early stage, but we do love the late stage where the mines are being built. Every bit of incremental capital might give you some volume for very low risk. So we do the lot.
Gotcha. Now, you had a slide up there, you used copper as an example, so I'm going to throw a copper question in there. Look, the current copper price has suffered this year due to the global recession concerns, and some would suggest that the market is not really recognising the massive imbalance between supply and demand. When do you think this will change?
So it could change tomorrow. But one reason it might change tomorrow, if one of the major mines had a civil disruption or some kind of tragedy or something related to weather, an 800,000 tonne per annum mine, something happened, the surplus in copper is only like 200,000 tonnes, if that. So supply disruption is a big risk that you can never predict. In terms of demand, it's harder. People are worried about recessions in Europe, the impact of recession in America, if it comes. There's no guarantee that it will come. So most people would feel as if they've got time on their side before buying copper. My personal view is that's a little bit of a risky strategy because something can change very quickly. But in any event, 25 or 26, it could come as soon as 25, 26, where we get a lithium explosion of prices, where copper is not $4 a pound, it's $8 a pound. But for me to accurately predict that accurately, I can't do it. I wish I could.
Tim Gerard, many thanks for your time. We'd love to get you back. Have a lot more questions we'd like to ask you, so
Okay.
we'll get you back in the future.
Right.
Thank you for your presentation
Thank you.
today.
Thank you.